If you trade gold and you're tired of random entries, badly placed stop losses, and emotional decisions, this video can literally change the way you scalp XAUUSD. Today, I'm going to show you my exact gold scalping strategy based on market structure, internal liquidity, and confluence zones. This is not a random strategy. This is not a signal strategy. This is a professional trading model based on clear and precise rules. I use M15 to define the direction, M5 to hunt liquidity and build the setup, and M1 to enter with surgical precision. This is the exact same logic used by institutions to trap retail traders before the real market moves. In this video, you will learn how to always trade in the right direction, how to use liquidity instead of being used by it, and how to trade gold with a tight stop loss and an excellent risk-to-reward ratio. So if at least one of these points interests you, make sure to like the video and subscribe to the channel. It helps the channel a lot. And most importantly, watch this video until the end because one single detail in this strategy can completely transform your results. Let's start. Before I reveal my full strategy step by step, let me first explain to you in detail each important pillar of this method. Because if you don't understand the logic behind every part, you will only copy rules, and that never works for long. This strategy is based on three fundamental pillars: market structure, internal liquidity, and confluence zones. And we're going to start with the most important one, market structure, because it gives you the direction. It tells you what to trade and, more importantly, in which direction to trade. Market structure is simply the way price moves. Does it make higher highs and higher lows, or does it make lower highs and lower lows? When the market makes higher highs and higher lows, the market is bullish. Lower highs and lower lows, the market is bearish. And this is the foundation. You cannot make consistent money if you trade against market structure. Why structure is the engine of this strategy. In this strategy, the market structure on M15 plays a crucial role. It filters bad trades. It removes 50% of direction mistakes, and it forces you to look only for buys or only for sells, never both at the same time. For example, if the structure on M15 is bullish, I only look for buy opportunities. Even if a sell looks beautiful on M1 or M5, I ignore it. And that's exactly the difference between a trader who clicks everywhere and a trader who waits for the right opportunities in the right direction. Very important. To confirm a continuation or a change in structure, I use two simple concepts: break of structure, change of character. A confirms that the trend is continuing. A signals that something might be changing. And as long as the structure on M15 does not clearly change, I keep the same directional bias. Golden rule: no clear structure equals no trade, no matter how good the setup looks on M1 or M5. Without a clear structure on M15, I do not trade. Now that you understand why market structure is the engine of this strategy, we can move to the second pillar, which is just as important: internal liquidity. And you're going to see that this is exactly where most traders get trapped, and how we are going to learn to use this trap to our advantage. Internal liquidity. Don't be scared by the word liquidity. In reality, it's very simple. Internal liquidity is simply areas where many traders have placed their stop losses inside a move or a consolidation. And where there are many stop losses, there is money for the market to take. Where to find internal liquidity? To keep things simple, we only look for two things: equal highs, multiple tops at the same level; equal lows, multiple bottoms at the same level. You usually find them in ranges, in small consolidations, or before an impulsive move. When you see the market doing this, it means many traders entered at the same place. and many stop losses are grouped in the same area. And the market loves to take those stops before making the real move. The market logic, very important. The market does not move randomly. It moves from liquidity to liquidity. Very often, before making a real move in the right direction, price will first take the internal liquidity, then continue in the direction of the structure. That's exactly why many traders get stopped out just before the real move. And we are going to learn to wait for the liquidity to be taken before entering. Very important rule. Not all internal liquidity is equal. In this strategy, we only care about internal liquidity if it is located in or near an important zone, such as a confluence zone, an order block, or a key M15 zone. Without that, internal liquidity is not reliable enough. Golden rule. No liquidity taken equals no trade. Even if the market is in the right direction, even if the setup looks good. As long as internal liquidity has not been taken, we wait. Now that you know how to easily spot internal liquidity, and more importantly, why the market almost always goes for it, we can move to the third pillar of this strategy, confluence zones. And this is exactly what will allow us to filter only the highest probability trades and avoid 90% of useless trades. Institutional zones, also called supply and demand zones. And this is exactly where the real moves start. Supply and demand zones, or institutional zones. A supply or demand zone is nothing magical. It is simply an area where the market left very strongly in one direction. And if the market left very strongly from that area, there is only one reason. Big players, banks, institutions, entered positions there. How to spot an institutional zone? Very simple. To keep it simple, a good institutional zone is a zone from which price left with a strong impulsive move, with little or no retracement, and that often caused a break of structure, BOS, or a change of character, CHOCH. In practice, this is what I do. I spot a strong, fast move. I go back to the last small consolidation or the last opposite candle before that move, and that area becomes my institutional zone. Demand zone versus supply zone. Demand zone. The market left strongly to the upside from this area, so I expect price to react bullish when it comes back greater than red square. Supply zone. The market left strongly to the downside from this area, so I expect price to react bearish when it comes back. Yellow warning sign. Very important rule, greater than. Not all zones are good. I only keep zones that created a strong and clear move, broke market structure, are aligned with the M15 trend. If a zone did not cause a real displacement of the market, I ignore it. The role of zones in the strategy. In this strategy, institutional zones are used to define where we want to trade and avoid trading in the middle of nowhere. We don't trade the market everywhere. We trade only when price comes back into an important zone. How everything fits together. Now the logic becomes very simple. M15 structure direction, M5 institutional zone, plus internal liquidity M1 equals entry timing. Now we can move to the most important part of the strategy, trade entries. And here, I'm going to show you 3 different entry styles. They are all valid, but they do not have the same risk, the same precision, or the same psychology. The 3 entry styles. In this strategy, you have 3 ways to enter a trade. 1, anticipation entry, limit order. 2, confirmation entry on M5 or M15. 3, precision entry on M1 after CHOCH. 1, anticipation entry, limit order. Concept. Here, you anticipate the reversal. You place a buy limit at the bottom of a demand zone, or a sell limit at the top of a supply zone without waiting for confirmation. Advantages: very small stop loss, excellent risk to reward. You often catch the best possible price. No need to stay in front of the screen. Disadvantages: lower win rate. You can get filled while price keeps going against you. Many zones don't hold on the first touch. Psychologically more difficult. For who? For experienced traders, or those who accept more losses but bigger winners. 2. Confirmation entry on M5 or M15. Concept: here, you wait for price to reach the institutional zone, then you wait for a clear confirmation candle on M5 or M15, such as a hammer/pin bar or an engulfing candle. You enter after the candle closes. Advantages: higher win rate than anticipation entries. You get a clear visual confirmation. Psychologically more comfortable. Fewer stupid losses. Disadvantages: bigger stop loss. Worse risk to reward. Sometimes you enter after the move already started. You can miss very clean trades. For who? For intermediate traders, or those who prefer safety over maximum performance. 3. Precision entry on M1 after XAUUSD. Sniper entry. Concept: here is exactly what you do. Price reaches your zone. It takes liquidity. You drop to M1. You wait for a XAUUSD, change of character. You wait for price to come back into a small zone, and you enter after confirmation. Advantages: very high probability, very tight stop loss, excellent risk to reward. You trade with market confirmation. This is the cleanest and most professional method. Disadvantages: requires more patience. You can miss some trades if price leaves without a pullback. Requires practice and discipline. More technical for beginners. For who? For traders who want precision, consistency, and risk control. Simple summary: anticipation entry equals more risky but more rewarding. M5/M15 confirmation entry equals safer but less optimized. M1 after XAUUSD equals best balance between precision, safety, and R. What I recommend. Personally, the best method in this strategy is the M1 entry after XAUUSD after liquidity is taken inside an institutional zone aligned with M15 structure. It is clean, logical, repeatable, and professional. Now that you know the 3 entry styles, we can move to the most interesting part, a real example on the chart, step by step. And you will see exactly how I apply this strategy from A to Z on gold. A real example on the chart, and not a made-up example. We're going to analyze a real gold move that happened on January 20th, 2026 at 15:30 GMT. You can check it yourself after the video. This type of setup appears very often, and in the long run, this model gives around 70 to 75% win rate when it is properly respected. The goal here is to prove to you that this strategy still works today and is based on market logic, not on luck. Step 1. M15 Analysis. Identify the trend. The first thing I do is go to M15 to identify the market trend. In our example from January 20th, 2026, we can clearly see that the market is bullish, higher highs, higher lows. So from this point, I only look for buy opportunities. First, we identify the trend on M15. Then we move down to M5 to look for the setup. Step 2, impulsive move plus break of structure. Then I wait for a clear bullish impulsive move. And this impulsive move will break a previous high, create a break of structure. This BOS confirms that the bullish trend is continuing. Buyers are still in control. Step 3, wait for an accumulation. After this impulsive move, the market does not continue in a straight line. It almost always pauses. In our case, price forms an accumulation/small consolidation inside the impulsive move, and most importantly, above the demand zone. And this is very important. Step 4, sweep plus return into the demand zone. Then, what does the market do? It takes the liquidity of this accumulation, then it returns into the demand zone. And this is exactly where everything is decided. Step 5, the entry. At this moment, you have 3 choices. Either you enter with an anticipation limit order, or you wait for a confirmation on M5 or M15, or you drop to M1 and wait for a CHOCH. Everyone chooses according to their profile and psychology. Stop loss and target. In this bullish model, the stop loss is placed below the zone below the last low. The take profit is targeted at the previous high or the next liquidity zone. And in our example, price reacts perfectly inside the zone and goes to the target with an excellent risk-to-reward ratio. And in a bearish trend. In a bearish trend, it is exactly the same logic but reversed. Conclusion. This real example shows one very simple thing. The market always respects the same logic. Structure to impulse, to accumulation, to sweep, to continuation. This is not luck. This is normal market behavior. Final conclusion. At this point in the video, you now have the complete structure of the strategy in front of you. What you saw today is not a magic strategy, a secret indicator, or a promise of easy money. It is a logical, structured, and professional model based on market structure, liquidity, and institutional zones greater than. And as you saw in the real gold example, the market always repeats the same behaviors. Why this strategy works? This strategy works because it forces you to trade in the direction of the market, stops you from trading randomly, forces you to wait until the market gives you a real reason to enter, and gives you precise entries with controlled risk. You are no longer trading candles, you are trading market logic. What you should do next? You can start using the strategy today, but before risking your money, do this. Backtest it, replay the charts, practice on a demo account, and understand it by yourself. The more you see it working with your own eyes, the more confidence and discipline you will have to apply it live. One very important thing to understand. Yes, this strategy does not give 20 trades per day, does not keep you trading all the time, but it filters 90% of bad trades. It puts you only in the best possible conditions, and that is exactly why it is powerful and profitable in the long run. In trading, the less you trade, the better you trade. The 2 absolute keys, patience and discipline. If you remember only 2 words from this entire video, let them be patience and discipline. Patience to wait for the right zone, wait for the liquidity to be taken, wait for confirmation. Discipline to follow your plan, respect your stop loss, and never trade out of boredom or emotion. Final message. This strategy can truly change the way you trade, not because it is magic, but because it is logical, simple, and professional. If you apply it correctly, if you backtest it seriously, and if you stay disciplined, the results will come. If this video helped you, make sure to like, subscribe, and tell me in the comments, are you going to backtest this strategy? And most importantly, protect your capital. The rest will come.